Okay, well, good afternoon, everyone. My name is John Evans, and I'm a lead advisor here at Foster Group in business development. And I'd just like to welcome you to today's webinar, which we are titling Retirement Planning Through a Crisis. And for those of you who may be less familiar with Foster Group, we're an independent registered investment advisory firm here in West Des Moines with offices in both Iowa and Nebraska. And we have the privilege of serving over 1,400 clients across the United States. We serve families, individuals, institutions, and retirement plans. Before we get started with today's presentation, just a few things we wanted to communicate. First, this webinar is scheduled to last 1 hour with a brief Q&A session at the end. So if you have questions, we'd be happy to get to those. This webinar is being recorded, so you will receive an email probably within 3 to 5 business days with a link to view the recording. At the bottom of your screen, there's a Q&A button, and if you have any questions we mentioned, we'd love to get to those, so just feel free to submit those throughout the presentation, and we'll try to get to as many of those as we can. Well, today's topic, I think, relates pretty perfectly to our vision of coming alongside those that we serve to help them live lives of meaning and generosity. And we help people to do that in a variety of ways, but really the big categories are going to be financial planning, investing, protecting, and giving. And ultimately, we believe that our role is to help ensure people's lives are truly cared for. And one of the things we've kind of talked about is that work really can't stop in the midst of a crisis. And today's webinar is actually going to be led by a friend and a colleague of mine, Walt Mosier. And before I turn things over to Walt, I got to brag on him just a little bit. So Walt has spent the past 18 years as a financial advisor and really helping clients build wealth and retire with confidence. He became a certified financial planner in 2001 and is a member of the National Association of Personal Financial Advisors. Became a member of that organization in 2005. He's also a chartered advisor in philanthropy, which is actually a designation focused on charitable giving. His experience and depth of knowledge in this industry make him well qualified to, I think, address this topic at hand. And I'm really excited to hear about that. So with that, Walt, I'm going to turn it over to you at this point and looking forward to what you have to share with us.
Thanks, John. I appreciate it. And thanks to everybody who joined today's webinar. Welcome. The one thing we're going to originally, when we were planning this event some months ago, is we were actually going to get together in a room and we were going to use this question as an icebreaker and just kind of throw that out there and say, well, why did you decide to come today? Well, obviously circumstances have changed a little bit, so we're doing this virtually instead. And I think the question still applies. We just have to approach it a little bit differently with social distancing and all of that. So what I'd like to do is just kind of maybe lay out some possible reasons why you're here. We've had investment accounts have been extremely volatile the last few months, beginning in February. So there's been a lot of turbulence in people's portfolios. Of course, the economy has tipped into a recession. We've seen double-digit unemployment sort of appear overnight, and there's things like I don't know, maybe Congress, spending $4 trillion of our money to sort of save the economy, so to speak. So those are some possible reasons. But I wanted to, before I get to a poll, I'm going to do a quick poll here in a minute, but just kind of addressing macro issues. I'm kind of big on what I would call megatrends. And one of the major megatrends of the last 25 years is that we've seen essentially the vanishing corporate pension. There's been a shift in one direction, and that shift has been to go from corporate pensions or corporations taking care of folks by establishing pensions to that burden shifting to people and individual employees having to save their own money inside of 401k plans. And that really started with the creation of the 401k. As a result, people are living in urban centers. They could be in very high cost areas. They're trying to pay off their school debt. They're trying to raise a family, pay their taxes. And yet somehow they still need to be able to put money aside for their own retirement. And all of this was, of course, before the government mandated shutdowns and the pandemic and now the civil unrest most recently. So I'm going to go, we're going to bring up a quick poll here. And this is where you get to use your mouse and click the answer that would best apply to you. So we're asking you actively to go ahead and just put down the answer that most closely would resemble the reason why you decided to log into this webinar. We'll go ahead and end the polling and share the results. So 38% of you said that you're concerned about your investments. An equal amount said you'd like to learn more about planning for retirement. And 25%, the remaining 25% said I'm concerned about the economy. So appreciate that. That's a good virtual way to kind of capture some of those answers. And I would just say, you know, we're in this together, right? I mean, we're all kind of in the same boat here. We want to work through this together, and I'll share some tips along the way. So we'll go ahead and end that. Now, the question on your screen is not a question that we as advisors would get verbatim. But really, if we're listening properly to clients, that's really what they want to know. I mean, deep down, if you kind of peel back the layers of the other questions that we often hear, it is in fact the most common question that we get. And, you know, it's no surprise that the fear of exhausting resources is deep set. It runs the gamut from people with, you know, just a moderate amount of money to people with quite a bit of money. And really, when you factor in the volatility of the investment markets, you know, say since February and March, that fear can really be overpowering and can overwhelm rational thinking in terms of thinking about assets and how those assets can ultimately provide for income during retirement. Now, as you look at this, this banner at the top here, you know, will I have enough to live to 95? You might ask yourself, well, why is he using 95? I'm not going to live that long. But, you know, as planners, we want to plan conservatively. We don't want to shoot a little short of the runway, so to speak. We want to make sure there's plenty of excess concrete for the plane to land properly. But, you know, people generally live within their monthly cash flow. And this pie chart really speaks to that in a very simple way. So the large 70% slice there is what we call lifestyle. And the lifestyle would be fairly mundane expenses like groceries and, you know, salon, personal care and dog food and things of that nature. Another 10% would be for savings or investing. And then of course 10% for things like, 5% for things like healthcare, 5% or more for giving, and then there's fun and travel. Conversation comes about when you start quizzing people about core needs, or what some people would say would be needs versus wants, and what's a need for one person could be a want for another. Now, the one thing I would point out here is that the 10% allocated to savings and investing, because if you're not putting money away, you don't really have to. You then convert into a spending mode, so that would probably be replaced by something else. Okay, let's address this long life expectancy a bit more. One of the reasons that we at Foster Group plan to at least age 95, and that's based in part on a conversation we have with clients about their families and how long their parents and grandparents lived. But we know from the 2010 census that there were almost 2 million people over age 90 living in America. And just to give you some context, that is enough people to fill up 110 Wells Fargo arenas in Des Moines. That's a lot of full Wells Fargo arenas. Now, many people go to Wells Fargo for a concert, so I'm not sure what band people in their 90s would go see, but that's a subject for a whole nother webinar. For a married couple, though, if you're age 65 there is a 50% chance that one of the spouses will live to age 93. So that's a pretty good shot. And often it's the female or the wife in the relationship. But a 50-50 chance means that we do need to plan pretty far out there. Interestingly, Americans 90 or older now make up about 4.7% of those over 65. And that statistic was actually 10 years old because it was from the 2010 US Census. But they project that by 2050, just 30 years away, that share will reach 10%. So that's more than a doubling in terms of our population over 90. So the point here being that long life expectancies are expected to be in our future, and data like this, just drives concerns about if people are going to have enough to get through their entire lives. Now, to this point, I came across this cartoon because it kind of speaks to the longevity issue. So it looks like a couple maybe in their 80s walking in the park, and the gentleman gets a phone call and says that, I got to get this, it's my mother. It's not clear to me, but that looks like it might be a flip phone. I'm not sure. I don't see the little antenna on the end, but it could be a flip phone. Okay. We're going to shift gears a little bit and talk about buckets of money. That may seem a little strange, but this is just a metaphor for how we can save money as accumulators in different tax buckets. So there's 3 distinct tax buckets of money. And the first one on the left that I'm going to talk through is what I would call the pre-tax bucket. So that's generally your employer-sponsored 401k plan, or your IRA, which you could roll out of a 401k when you leave a certain employer. Now, the contributions that go into this bucket are going to be pre-tax. So your employer puts the money into your account before income taxes are taken out, and then once inside that account or that bucket, it grows, of course, tax deferred. No taxes are due on any of the earnings or accumulations. And then once the retiree decides to start taking income, it comes out and is taxed as just regular income. It's taxed like pension income. You wouldn't pay Social Security or Medicare tax on that money because that part is already taken out of your check when you made the contribution. The second bucket of money is what we call the tax-free bucket of money, and that's on the right here. So it's generally thought of as Roth 401k, Roth IRAs, and the money goes in after tax. So you pay tax on your earnings, you put the money in, it grows tax deferred while you're earning and saving. But then the nice thing about this one is when you take the money out down the road, the withdrawals are tax-free, and they're tax-free from federal income tax and generally state income tax as well. So that's kind of a nice tax diversifier, if you will, because that's, if you need to pull money out for something, let's say a vacation or a home improvement, you don't have to gross up the amount you need by some percentage to pay the tax man. You just have to take out whatever you need. The third bucket of money, I'm going to pop in one more slide. Whoops, a little too fast. Is the third bucket of money is called an after-tax bucket. And it's just like a brokerage account. You just go down and you open up an investment account. Contributions are with after-tax dollars, so they're not deductible. And you put the money in, there's no tax deferral either. So whatever interest, dividends, capital gains might be generated in that account, you are going to pay tax on those, on that appreciation from year to year, which is important to kind of figure out how to minimize that. And a good financial advisor can help you with that. And then any withdrawals are taxed at capital gains rates. Now, why is that important? Well, that's important because capital gains rates are distinctly different from ordinary tax rates. Now, many clients of ours would be in the 22% tax bracket in retirement. Now, that covers a pretty wide swath of income from A married couple from about $80,000 up to $171,000. And if you're in that rate on appreciated assets is 15%. So if you're pulling money out of your IRA, you're paying 22. If you pull money out of a brokerage account, you're only going to pay 15%. Which one would you rather pay? Obviously, that's a rhetorical question. You'd rather pay less. But if you don't have that third bucket of money at your disposal, then you really don't have that option. And what I like about the buckets of money approach is if while you're saving and accumulating for retirement, you can, create relative equal balances among these three buckets, if it's possible, then you have the ultimate flexibility to pull money from whatever bucket you want in retirement. And it, depending on what Congress does with tax rates, they're always making changes. So if ordinary tax rates are really high and capital gains rates are low, then you would pull from that after-tax bucket or your Roth IRA. The other thing I would mention about these two on the right here is that neither one of them has a required minimum distribution requirement. So you don't have to start pulling money out at age 72, which is true of the one on the left. IRAs, you have to start taking money out at 72. Now, my earliest memory of a crisis in the nation or in the world is, and I'm going to age myself here or date myself, but it actually goes back to 1973. And I'm sure some of you may remember when we had the Arab oil embargo. And I was 8 years old, and I remember sitting in a gas line with my dad, and we were just sitting there waiting to pull up to the gas station to get $10 worth of gas. They were even rationing the amount we could take. But that was my first kind of early memory of like, oh, we're going through something a little bit unusual here. This chart goes from 1970 to present day, roughly, and it sort of represents the growth of a dollar in the stock market. The point being that there have been lots and lots of crises throughout, those essentially 50 years, and retirement planning did not stop during any of these particular downturns. I'll kind of circle a few of them here. Who can forget the dot-com bubble bursting, and of course the 9/11 terrorist attacks. And then just 12 years ago, we had the subprime mortgage crisis, and the S&P 500 dropped 50%. I especially remember the after the 9/11 terrorist attacks. My father-in-law passed away right before that. Actually, that's not true. A couple months after that, and I remember thinking that gosh, I mean, I'm going to be living in a world where we're going to have all these ongoing attacks in our country, and I was really feeling pretty despondent about the whole situation. But ultimately, that's not the way it played out. So my fears or my uncertainty and anxiety really were not warranted when you kind of reflect back on that. And I think that's a good lesson for people, is to just remember that we've been through a lot of this stuff before. I hear people say, well, this time it's different. Well, that's true. But every single time we have a crisis, it's different. That's the point. And so you can't predict these things, and you really, you can draw some experience from it and some wisdom from it. And I guess that's what I would encourage people to say. Hey, John, I know that you started, I think, at Foster Group right around the time we had the Great Recession.
Yeah, that was, I was smiling as you were kind of circling some of those pieces, but I remember I started in July of 2007 as a new graduate from college, and landed at this firm thinking, oh, this is great. This is so fun. Had zero concept. And then we went through 2008, and we went through a major skid, and thinking, oh my goodness, I just started. I'm the low man on the totem pole. They're going to get rid of me. And fortunately, Foster Group was, we weathered that storm, I think as good as any, just through, some of the things we talk about with diversification and building portfolios, but also helping clients retire in the midst of that. I think that was an incredible lesson and experience that I value, even as painful as that was, kind of going through that together. But I think it's made me a better advisor and can bring some better perspectives because of that experience. And so I'm right there with you. There's never a shortage of things to be concerned about, but just keeping perspective all along the way, I think, is critical.
Yeah, I agree. Thanks, John. Our friend down the road in Omaha, Warren Buffett, only the greatest investor to ever live, he said this about forecasting and in a larger way, maybe uncertainty. Forecasts tell you a great deal about the forecaster, they tell you nothing about the future. And so, we believe in the idea that when you consider everything about life that's uncertain, from employment markets or just the job market and employment uncertainty, to the stock market, to weather, to politics, to sports, almost everything is outside of our control. So you have to, at some level, decide to embrace it and just kind of roll with it. We do not believe that you can predict the future or predict future market movements. We are certain that market timing does not work because the future is just honestly unknowable. I know there tend to be loud voices that sort of appear after the fact and say, I guess they engage in a lot of what I would call armchair quarterbacking, but generally they're not helpful and they're really not able to, create a better investment model. All right, a couple of tips that you can take with you to your next holiday party. These are kind of back of the napkin rules I thought I'd share with you guys about how money actually grows if you know a given investment return. So the first one is called the rule of 72. And it's pretty simple. It's just a fraction. So you just take the number 72, you divide it by the rate of return that you're assuming for your investment account. So I just made the math easy here. I divided it by 7.2% and I get 10. And that is how many years it will take your money to double in value. So let's say you had $100,000, you earned a consistent 7.2% return, which is pretty hard to do, but let's say you did it. And at the end of the 10th year, you would have $200,000. That's called the rule of 72. Just kind of slip that in your hip pocket and use that at the next cocktail party you're at. The second one is the rule of 115. Similar, but it actually tells you how many years it would take your portfolio to triple in value. So 115 divided by an assumed rate of return, in this case of 5%, that would take 23 years for your nest egg to triple. Now, keep in mind, this does not assume that you're contributing dollars all the way along. So you really can't apply it to a 401k because, you're adding money, it's going to grow faster still. And it also, of course, doesn't include if you're taking money out. It's just a quick kind of, basic calculation that you can remember or think about in terms of if you have a dormant IRA or something and you're trying to figure out what it's going to be worth so many years down the road. So the rule of 72 and the rule of 115 at no extra cost for today. All right. How money grows. So I'm going to show you a chart. It's kind of maybe a little bit hard to see. I'm going to zoom in on the lower left. So that should be a little bit bigger for you. This is a very typical chart for how a nest egg or an IRA or 401k might grow. What you see at the bottom here we have a fictitious couple. Their ages 66 and 62. And this would be the first year of retirement. So the scale here is that they have a $750,000 to their name. That's just their investable assets. And so each of these green bars represents essentially a year, and it shows how the money kind of grows. And we're applying a investment rate here. I think it's around 6.2%. So you see that, and we assume here that they're actually pulling money out and spending money, but most of it's remaining invested. You see how it grows from about 750,000 all the way up to it may peaks somewhere in here, and that's around I guess the early 90s. The key thing is you don't want the money to peak all the way back here and start to fall, because then you might run out too soon. So when you run your retirement reports, you want to make sure it's not peaking too early. Ultimately, The problem with this chart, though, is that we're assuming a kind of a constant rate of return. Let's say it's 6%. Well, how many people are invested in the stock market that earn a 6% return every single year? It just doesn't happen, right? So there is another tool that we can introduce to create the idea that there's volatility in the market. And I'll show you what that looks like. So it's actually, it's a probability of success number that we can show you. And what that does is it takes actual stock market returns from history, and it just randomizes 1,000 different scenarios, and it comes up with like all the best and all the median and all the worst scenarios, and it calculates this probability of success number. And that's a pretty good gauge for figuring out if the nest egg is going to have a pretty good shot. Now, a lot of people ask us, well, what does that mean? Is a 7% chance that I could completely run out of money? Well, not really. I mean, it's a 7% chance that you might have to make some course corrections along the way. Maybe during a period where there's an economic recession, you might have to tighten your belt a little bit, strap on an extra tight seat belt, or cut expenses, maybe cut out that second vacation that year. Whatever the case may be, if you have some discretionary income, you might want to cut back a little bit until that period passes. And then that would give you a much greater chance of actually closing that gap and just getting close to 100% probability. Now, what if you retired and suddenly in your first or second year of retirement, in the same scenario, suddenly you had a $100,000 unexpected expense? Now you might say, well, that sounds like a stretch. Years ago, however, I did get a phone call from a client, that's not a foster group client, so you don't know these people, who said that they needed to draw out $60,000 from their account. And I said, okay, tell me about that. And they said, well, our granddaughter is very important to us, and she has gotten involved in some, substance abuse, and she's addicted, and we want to invest in our granddaughter, and we want to send her to a special school where she can not only get an education, but, basically get off the drugs or whatever the issue was. And they wanted to take that money out of their account and basically, invest in their family, as I said. So what do we do there? Well, I sent the money out, and the 1 year of tuition in their case was $60,000. So what we could do is say, all right, let's build in that scenario for you and come up with a new probability of success. So if we did that we'd move from 93% in the prior scenario to here we have an 83% probability. Still pretty good. We'd like to see 85 to 100%. That's kind of the green zone, but it's just below the green area. And honestly, if they made a few small changes, it would probably be back in that green area here pretty quickly. But it's a way for us to, as advisors, to on the fly kind of analyze things in life that kind of just pop up and are unexpected. The last scenario I will show you is probably one that a lot of retirees think about, especially if they don't have any sort of plans for long-term care. So this is a fairly draconian drop here on the right. You can kind of see they're cruising along, and all of a sudden we have the husband needs long-term care. And so I built in an expense of $90,000 a year, beginning at age 90, lasting for 5 years, and then the husband passes away at 95. And you can see, assuming there's no long-term care insurance in place, that the portfolio can drop fairly rapidly. And that's where, we would model this ahead of time, and we would have a conversation about how can we improve on that situation. I'm not even going to show you the Monte Carlo because it's not so good, but it is important to consider these contingency type of events. Okay. All right. So we at Foster Group, love to help people accumulate, but this is not exactly how we would approach that subject. We don't say, are you ready to start investing, or do you want to keep throwing your money away? But it is a conversation that, people come to us and they want to have. So I thought that was a little tongue-in-cheek humor. All right. What about managing your retirement account. Let's say that you're already retired and you face a crisis. And let's look at the portfolio on the right. So we have a $500,000 portfolio. We have 60% in stocks, 40% in bonds. And we're going to say that the 40% in bonds is what we would call your financial lifeboat. In other words, it's a plan B when your plan A goes awry. So in this example, if we use a $500,000 balance, 40% of that is 200,000. So we're going to have 200,000 in bonds. And I'll show you here in the next slide why that is important, especially during a period where you might have an extended stock market pullback. So let's say that you need 20,000 a year from your portfolio. And I just show on the table on the right, I've inflation adjusted it by 3% a year. So you can see years 1 through 6, and then I kind of ran out of room, so I skip over to year 10. But if you had 200,000 in your bonds, you could effectively pull 10 years worth of income from just the bond side of your account and leave the stocks to whatever, gyrate during that period, go up and down, and hopefully recover. Now, we know from history that there's never been a period in the stock market, I guess, historical averages going back to the 1920s, that 8 years is the longest time period where you had the market at a certain level, and then it dropped and fell to the bottom, and then it came back to that original level. That was an 8-year span of time. Even in the Great Recession in 08, 09, the S&P took about 6 years to get back to where it was in October of 2007. And so I think that having the right high quality bonds, the bonds that are not junk, they're investment grade, they're AAA, AA rated, those kinds of bonds are a great backstop to any sort of crisis planning or crisis environment that you might find yourself in. And so, we've done this at Foster Group for years. It's just kind of built into our DNA, and we believe in it pretty strongly. A lot of people ask us, when I do retire, how do I know how much I'll actually need from my portfolio? And when will I need to start pulling the money? I'm so used to just living on my earned income. How do I know what to do and when? Now, for those of you that are not especially fond of numbers, I want you to place your finger lightly on the eject button right next to your chair, but don't press it yet. Don't press it. We're gonna try to get through this together. I will not go through every number on the next few slides, and I promise there is another cartoon coming up. So just hang in there. Okay, tighten your seatbelt. First slide, we're just looking at income. So here's a 5-year cash flow projection. And the first thing you might notice, we got our fictitious couple up here at 64 and 68. And we have a couple of years of strong salary, but it does sort of taper off in that 3rd year. And that's because that would be a partial year. So this person is retiring in 2022, and then you see no more salary after that. Okay, so they're kind of approaching, they're in the pre-retirement years. They're trying to figure out, where do we pull our money from, or how much do we need? Now you see one of the spouse or the other spouse is getting Social Security. That's the next row. Pension, there's a wife's getting a pension, it's flat. Let's just say that's IPERS or some governmental pension. RMDs would represent required minimum distributions. So there's nothing going on there until the older spouse reaches age 72 and has to start pulling that money out of their IRA. And then the bottom is just kind of adds it all up. So you see strong cash flows the first 2 or 3 years, and then it drops, and then it comes back up a little bit. Okay, that's just on the income side. Hopefully we're so far so good. Then we're going to look just at expenses. Now, when we talk about living expenses, that first row there, that is, just the normal stuff that it would take to pay your bills, groceries and pet food and salons and all that stuff. So that's just, you can see that runs between about 75 and 80,000 a year. I'm going to come back to the miscellaneous category in a second. So let's go down to debt. You see that would be loan payments. And then insurance premiums, pretty standard stuff. Income taxes, you got to pay the IRS. And then planned savings, that bottom row, that would be the money that the worker is still putting in their 401k plan. So that's kind of the annual limit for contributing to the 401k. Now, let's go back and talk about the miscellaneous category. When they had higher income the first couple of years, we're assuming that there's extra money available. So they're not spending all of it. And in this case, we are assuming it's being spent. So we're just throwing it into a kind of catch-all miscellaneous category. I think everybody has a miscellaneous category. Maybe it's the money they pull out of the ATM or whatever, but we had to throw that into some kind of spot. So that's what that is. Okay. We add these all together. So we have income at the top, the same things we saw 2 slides ago here, and then the expenses down below. But the numbers you want to focus on are right here at the bottom. This is what we can tabulate as to what these people are going to need to pull from their investments each of those 3 years. And that's just basic math. You're adding up the numbers, you're adding up their income rather, you're subtracting the expenses. And that's how we can kind of zero in on, all right, you're going to need this much coming out of your portfolios. So it doesn't specify if it's IRA money or after-tax money. The point being that, that's a second part of that discussion. So I hope that made sense and wasn't too much detail there. We're going to skip past that. All right, so other considerations. There's more than just the annual cash flow consideration. There's things like, how do I know when to retire? Is it a question of, are you getting burned out? Are you being downsized? Or are you just looking for, more of a RV lifestyle? It could be any number of things. Do you want to work part-time or do consulting? Lots of people will leave their employers and then go back and do the same kind of work, but on a consulting basis. Questions crop up all the time about how and when do I begin Medicare? And what about Medigap or Medicare supplement policies? Now, Medicare Part A is pretty straightforward. It's the hospital insurance. Everybody gets it automatically at age 65, and it's free. But Medicare Part B, that can depend on if you're still going to work past 65, and it can, your premium can be different depending on what your income looked like 2 years ago. They actually look back 2 years at your tax return, and then they determine your Medicare Part B premiums for the current year. So we're in 2020. Those premiums would be based on your 2018 tax return. And then for people who want to retire sooner than 65, what about purchasing health insurance? It's getting harder and harder to find independent health insurance policies. We talked about pensions. Many pensions have gone away. There are still some out there. IPERS is probably the most common one in Iowa. I would say a very, very common question is, when do we start Social Security? Now, a lot of the interesting strategies around, file and suspend, things were around 4 or 5 years ago, are all gone. So what it comes down to is really 2 questions. Do you think you're going to live past about age 80 or even into your 90s? And if you do, a lot of times it might make sense to delay, but not all the time. And then once you figure out when you're going to take Social Security, the question becomes, if you delay, that's going to put more pressure on your investments to deliver income, right? If you got to pull more money out of your investments because you're not getting Social Security, we have to kind of test that and figure out, is that putting you in a worse position in the long term or a better position? And then, when to begin retirement account withdrawals. We know IRAs have to start coming out at 72. Examining opportunities for Roth IRA conversions. If there's a way, if you sell a business and you got cash from your business and you can live on the cash for 2 or 3 years, then maybe your tax bracket is so low it makes sense to do some Roth conversions. Very, very possible. And then you can see blending income. That gets back to the buckets of money talk. And then if you have life insurance policies, a lot of people say, well, do I need to keep this policy or can I save on the premium and give it up? Lots of different options there, especially if you have cash value as opposed to, say, a term policy. Okay. Now, in terms of, foster group and sort of how can we serve, think of this slide as being like 4 lanes in a pool. So you got 4 swimming lanes. The one on the left is really about some of the topics we touched on, cash flow planning, retirement planning, tax return reviews, and things of that nature. It's what I would call sort of blocking and tackling when it comes to financial planning. The second one is about investment help. So can we help you establish and review investment goals and objectives, determine a proper investment mix, if you think of that classic pie chart of asset classes. And then if you're in a brokerage account or a taxable account, how can you keep that annual 1099 income down, keep your taxes down so you're not just getting eaten alive by interest, dividends, capital gains, that kind of stuff. And then the third one is protect. So that's all about making sure you're properly insured for the unexpected. Quick disclaimer, foster group does not sell insurance. We talk about insurance, but we don't sell it. We don't receive any income from commissions. But long-term care insurance is something we certainly would help with analysis and making sure that your property is insured, Medicare and all of that. The last column is about giving. It could be estate transfer. Do you have the proper estate documents in place? And then interestingly, people think charitable giving is all about just writing checks. There are some pretty interesting tools around giving money to charity and actually getting an income stream back for your lifetime, especially during your retirement years. And then the money would go to charity after you're both gone if you're a married couple. So it's not just about writing checks or even transferring shares of stock. Those obviously work, but that's the last one. And I think we have another poll that is just a quick, so if you can see this poll, it's, again, what topic is of greatest interest to you? And you can just kind of click with your mouse again if the one that is most applicable. Obviously, not every single one is going to fit every single person. So we got a few people weighing in here. Let's go ahead and end the poll. And it looks like around half of you are concerned about taxes. And a third say they need a financial plan, and the rest is looking for some investment help. So fantastic. Appreciate everybody contributing their thoughts on that. All right, we'll go ahead and end the poll. And get to nearly our last slide. So really, as we kind of wrap things up, you have 3 basic options. You can, if you're not somebody who's interested in this kind of stuff, you can just ignore or hope it all works out. Honestly, I think a lot of Americans probably do that just as a default, or maybe they don't hope that it's going to work out. They just don't even think about it or don't address it. Probably not the best option. I mean, eventually your earned income is probably going to stop and you need to have a plan. But you could do it yourself. You could read books, you could read articles, magazines, go online. There's lots of resources out there. I had a client, again, not a foster group client, this is a previous firm, but he emailed me after one of our regular meetings and he said, in theory, everybody could sort of do this themselves. The problem is you lack the time. And if you're working in a career and you're busy, most people don't want to spend their evening hours reading books and reading articles. And so he said, in theory, you could do it, but you don't have the time. And he said, we should have done this years ago. The third option, obviously, is to delegate that task, and you could hire an expert and let others work with you. I don't think people need to hand over everything blindly. That's probably not the best plan, but to kind of work in tandem with somebody who can walk you through, the maze of options and different choices out there. So, foster group, we don't have a full book. In other words, we have capacity, and we would like to apply for that position. If you're thinking about hiring somebody, at least come in and kick the tires, so to speak. All right, we're getting close to the end. We're going to almost at the point of turning it back over to John, but I love Dilbert, one of my favorite cartoons. And here you see the employee says, "I retired from my life of corporate crime and put all of my illicit earnings in a mutual fund." To which Dilbert replies, "How do you know the mutual fund is legitimate?" And he says, what? And then you see the boss man on the right. Have we got all the money back? And Dogbert says, what do you mean we? So kind of a funny cartoon. I enjoyed it, but it speaks to the concern that some folks have around money and the security of their money and the legitimacy of it. So I just want to make the point that if you hire an advisor, be sure to check them out. There's actually a website you can go to called investor.gov. It is run by the SEC, the Securities and Exchange Commission, which is our regulator. And you can look up individuals, you can look up firms, you can look up Foster Group, you can look my name up and see if there are any disciplinary actions or any black marks against that firm or that advisor. So do your homework before you make a decision. I can save you a little bit of time. I did look myself up and I looked up Foster Group and it looks like we have a clean bill of health. So I just wanted to kind of throw that out there. And I believe we are at the point of our Q&A session. So John, I see you're back on.
Yeah, no, great. Yeah, that's that was really good. And we've had a few questions come in. I've just been trying to diligently monitor those. So if you are on and you do have a question that you'd like to submit, I just encourage you to maybe type that out in that Q&A button at the bottom of your screen. But just a couple of good ones, Walt, that I just like to pose on behalf of the good of the group here. But first one is, I think, pretty fascinating. I'd love your thoughts on it. But what do you think is the biggest mistake that most people make in retirement or transitioning to retirement? But if you can kind of think, what is that big mistake that most people make?
Oh, I can think of a couple of things that I've seen over the years. Number one, and this is probably more in the accumulation phase, like when they're still working, is you just I think people acquire financial accounts or financial products on what I would call just kind of a random basis. I'm not sure how they end up acquiring things, but I would say there's no overarching plan. There's just accounts here and there. And there was really no overarching strategy is what I meant to say. There's no strategy or thought to how they're putting things together. And so that's one thing. In terms of transitioning into retirement, I would have to say a lot of times I'll see their investment statements if they hire us and they have a brokerage account that has maybe 10 or 12 stocks. And they might be decent stocks like Apple and, the blue chips, the big large cap stocks. But they'll think that 10 or 12 stock portfolio is a diversified portfolio. They might even, say that it's just like a mutual fund. And that's just not true. I mean, mutual funds have 100, 150 underlying stocks in them. And, portfolios that are properly put together might have 15,000 individual stocks and bonds. And so that's true diversification. If you have 10 or 20, that's just not. Because what happens is those people not only have market risk, but they also have another layer of risk on top of that called company risk. Because if one of those companies files bankruptcy, like we saw back in the early 2000s, Enron was a big company, big energy company, and they essentially went out of business within a few weeks. And those employees that had all of their 401k in Enron stock, and then they had Enron stock outside, they were devastated. And so if you have one stock like that in your portfolio out of 10, that's not going to work out well. So I think taking too much risk is probably the big thing that I've seen.
That's a great answer. And actually it sets up the next question, which is, how does Foster Group, manage risk? So when we think about managing risk, how would you answer that?
In a couple different ways. I mean, we talked about the lifeboat concept. So there's always going to be risk as an investor. If you don't want any risk at all, you shouldn't be in the market. But assuming you're able to accept, a moderate level of risk, we do a couple things. We create very well diversified portfolios across lots of asset classes. And we do that in order to invest not only in the US, but across the world, because other parts of the world have markets too, of course. So we diversified across not just asset classes, but country borders and boundaries. And then not only do you get equity diversification or bond diversification, but you get currency diversification, because now, some of your investments are dollar denominated and some are in foreign currencies. And as the dollar strengthens or weakens,
Mm.
you can get some return that way. The other thing I would say is that, we have a tilt towards investments that are um, more value oriented. And what I mean by value oriented is you're paying a lower price generally for stocks, given their revenue and their income and their dividends, as opposed to paying a very high price. So that can be a hard concept to grasp. But if you think about buying anything, you go to the mall or you go to a store, and you always want to get the best possible value for your dollar. So you're going to look for things on sale. You're going to look for stuff that maybe you want to buy at full price, but you're going to hold off and buy it at a cheaper price. It's really no different with investing. You want to look for investments that are greater value and have a lower price point. So we look for that, or we look for those kinds of deals in the markets.
Yeah, that's good. I think I'll maybe do one more and then we'll wrap things up.
Okay.
I think I saw a couple of questions actually come in around like Monte Carlo. And I think that the general theme is, what's the, just like, what's the best way to think about that? Or is there a number that we target for a success rate that people should kind of have some confidence around? Or can you speak a little bit more to that?
Yeah, the Monte Carlo is that probability of success number that I showed about halfway through. And 1,000 different market, I guess, simulations is pretty robust, but it may not cover every single possible scenario. The greatest risk to most investors is going to be in those first 1 to 2, maybe 3 years after they quit their job and now they're living full time on their money.
Right.
And the reason, of course, is if your portfolio drops 20 or 30% in year one, you've just dug yourself a hole, and it's hard to dig out of that when you're pulling money out of your account. And so, there's things you can do. You could put aside a couple of years worth of cash and use that as a safety net. But, we've got the lifeboat, the bond portfolio is kind of built in for that purpose. And so, I think those kinds of ideas are the best way to tackle the risk. But the technical term for market drops right after people retire is called sequence of returns risk, and it matters the order of the returns that they get in their portfolio. Let's say over a 20 or 30-year period. If you retire and get positive 20 or positive 30% returns for the first couple of years, you're probably not going to have any problem, passing that probability of success number. But one of the things we do in our financial planning process is we can test before somebody retires. We can say, well, what happens if you lose $200,000 or you lose 20% of your portfolio in year one? And we can kind of run that hypothetical before they even actually have that event happen to them and say, if this were to happen, you're going to still be okay. Or, you might want to do this or that to shore that up a little bit. Does that make sense?
So yeah, it really does. And I think that hit on multiple, kind of questions that came in that were in that same channel. So, yeah, I think with that, we better wrap things up. And I just want to say thank you. It's really, I work here and I learn things. So thank you so much for just sharing your knowledge and your wisdom on this topic. I know it's been a very unsettling time for all of us, and so I think it's very timely. So just as a reminder to everyone on the call, this has been recorded. So if you want to rewatch any part of this, there's going to be a link that'll be sent out to you shortly. We're targeting 3 to 5 business days to get this out. So keep an eye out in your inbox. And it's also going to be available in our July newsletter. And I also wanted to speak to you, if there's people that have joined us that already have a relationship with us, I just want to say thank you. Thank you for walking and trusting the leadership and the direction of our firm and how we've navigated through these uncertain times, and just leaning into wisdom and prudence all along the way is what we're trying to do. And so I just want to say thank you as we kind of try to live out the mission of this firm. For those of you who may not have a relationship with Foster Group, or if this prompted any questions that you may have about your situation, we just encourage you to contact us to set up a conversation. And if we can be helpful in any way, we want to do that. And so I just encourage you to take a look there. I think our email addresses are on the screen. So if you want to start a conversation with Foster Group, we would encourage that. And lastly, we want to get better at hosting webinars and bringing relevant content. And so, we'd encourage you to, there's going to be a feedback survey that'll be sent to you. And so we encourage you to give us your feedback. So if we hit the mark, if we didn't, and if there's other topics that you want to hear about in the future, we encourage you to submit that form, and we'll be sending that out here shortly. But in order to kind of give you a little bit of incentive to do that, we're going to be donating $5 to the Food Bank of Iowa for every survey completed, up to a maximum gift of $500. So just encourage you to do that. We're always looking to sharpen our sword a little bit as we do these things, and we'd love to hear from you in that way. So that concludes the presentation for today. Thank you so much for spending some time with us. Have a great afternoon, everyone.